London, 1720. Sir Isaac Newton, the greatest scientific mind in human history, the man who discovered gravity and the laws of motion, sat in his study staring at a piece of paper. It was a stock certificate for the South Sea Company. He had just lost $20,000, equivalent to about $3 million today. His entire fortune gone. Newton, who could calculate the motions of the planets with perfect precision, had failed to calculate the madness of crowds. He later said, "I can calculate the movement of stars, but not the madness of men." Newton wasn't alone. Thousands of Britons, from servants to lords, from merchants to members of parliament, had just been bankrupted by the same company. The South Sea Company's stock had risen over 1,000% in less than a year, creating a speculative frenzy unlike anything the world had ever seen. Then it collapsed, wiping out fortunes in weeks. This wasn't the tulip mania of the previous century, where people traded flower bulbs. This was different. This was a modern stock market bubble, complete with financial engineering, government corruption, insider trading, and mass hysteria. This was the South Sea Bubble, history's first great stock market crash. And the lessons from 1720? We still haven't learned them. To understand the South Sea Bubble, you need to understand Britain in 1720. The country was dealing with a massive problem: debt. Years of wars, particularly the War of Spanish Succession, had left Britain with a national debt of over $50 million, an astronomical sum at the time. The government was paying enormous interest on this debt, draining the treasury. Enter the South Sea Company, founded in 1711. The company had a monopoly on British trade with South America, specifically the lucrative slave trade. On paper, it was a legitimate trading company. In reality, it was about to become the vehicle for one of history's greatest financial frauds. In 1720, the South Sea Company proposed a scheme to the British government. They would take over the entire national debt. In exchange, the government would give them various privileges, and the company would convert government bonds into South Sea Company stock. Bondholders would swap their government debt for shares in this exciting, profitable company. It sounded brilliant. The government would be relieved of its debt burden. Bondholders would own stock in a thriving enterprise. The company would profit from the difference between the debt's interest rate and their own costs. Everyone wins. But there was a catch. The whole scheme required the South Sea Company's stock price to keep rising. If the stock price fell, the entire structure would collapse. So the company's directors had one job: keep the stock price going up by any means necessary. What followed was a masterclass in market manipulation, corruption, and mass delusion. And it worked until it didn't. In January 1720, South Sea Company stock was trading at £128 per share. The company launched its scheme to take over the national debt and immediately began a propaganda campaign to drive up the stock price. First, they spread rumors of incredible wealth: South American gold, silver, lucrative trade routes. The company's directors hinted at profits beyond imagination. They suggested that dividends could be 30%, 50%, maybe even 100% per year. It was fantasy, but people believed it. Second, they made it incredibly easy to buy stock. You didn't need to pay the full price up front. You could buy on credit, paying just 10% or 20% down and owing the rest later. This let people with limited means speculate on a massive scale. A servant making £50 a year could buy £500 worth of stock by borrowing against future gains. Third, and most corruptly, they bribed everyone who mattered. Members of Parliament received free stock or incredibly favorable terms on loans. King George I himself was given a large grant of stock. Government officials, aristocrats, even the king's mistresses got payoffs. The entire British establishment became invested in keeping the bubble inflated. The strategy worked spectacularly. By March, the stock was at £330. By May, it hit £550. By June, it reached an insane £1,000 per share. In 6 months, the stock had risen over 900%. People who had bought in January were suddenly sitting on massive paper fortunes. The mania consumed Britain. Coffee houses buzzed with stock tips. Servants quit their jobs to trade full-time. Merchants abandoned their businesses to speculate. Everyone had a story about someone who'd gotten rich overnight. FOMO, fear of missing out, gripped the nation. Here's what made it even crazier. Copycat companies appeared everywhere. Seeing the South Sea Company's success, entrepreneurs launched hundreds of new companies with wild business plans. Some were semi-legitimate. Most were complete frauds. There was a company for carrying on an undertaking of great advantage, but nobody to know what it is. Literally, they wouldn't even tell you what the business was. Just trust us, you'll get rich. That company raised £2,000 in a single day before the founder disappeared with the money. Other companies promised to extract silver from lead, make salt water fresh, trade in human hair, or develop perpetual motion machines. One company claimed it would build floating islands in the ocean. Another would insure servants against theft. The schemes were absurd, but people invested anyway because everything was going up. Even Isaac Newton got caught up in it. Newton was not a naive man. He was the president of the Royal Society, the master of the Royal Mint, one of the most intelligent and cautious people alive. But in early 1720, he saw South Sea stock rising and made a calculated decision to invest. Newton bought shares in April at around £300 per share. He watched them rise to £1,000 and felt like a genius. But Newton was a scientist. He understood that what goes up must come down. So when the stock hit its peak in June, he sold. He made a profit of about £7,000, a significant sum. Newton congratulated himself on his rational decision. He'd played the bubble and gotten out before it burst. But then he watched the stock continue to rise. In July and August, even after he'd sold, the price kept climbing. Newton watched his friends and colleagues making even more money. That's when Newton made his fatal mistake. He couldn't stand being left behind. In August, he bought back in at the top, paying around £1,000 per share. He bought heavily, investing most of his fortune. Within weeks, the bubble burst. Newton lost everything. What made the South Sea bubble different in the 1700s from tulip mania or other early speculative frenzies was the level of government involvement and corruption. This wasn't just a private bubble. The entire British state was complicit. The South Sea Company's directors understood that their scheme required government approval and protection, so they systematically bribed everyone who mattered, but they did it cleverly. Instead of crude cash payments, they offered something more valuable: insider access to stock. Here's how it worked. Let's say you are a member of Parliament whose vote is needed to approve the South Sea scheme. A director approaches you and says, "We'd like to offer you the opportunity to purchase £10,000 in stock at the current price of £150 per share." You agree, but here's the trick. You don't actually have to pay anything up front. The company carries you as a debtor. Then the company drives the stock price up to £1,000 per share. Your $10,000 investment, which you never actually paid for, is now worth $66,000 on paper. The company then says, "Would you like to cash out?" You say yes. They pay you the £56,000 profit, minus the original £10,000 you owed. You walk away with £46,000 in profit without ever spending a penny of your own money. This wasn't technically a bribe. It was a stock opportunity that just happened to make you incredibly rich right before you voted to approve the company's schemes. Dozens of MPs received these deals. So did members of the House of Lords. So did the King's ministers and advisors. Chancellor of the Exchequer John Aislabie was one of the chief promoters of the scheme in Parliament. He received massive stock grants. So did James Craggs, the Postmaster General, and Charles Stanhope, Secretary of the Treasury. These men had the power to help or hinder the company, and the company made sure they were financially invested in its success. Even the royal family was involved. King George I received a large grant of stock. So did his mistresses, the Duchess of Kendal and the Countess of Darlington. Having the king himself invested in the company was the ultimate stamp of approval. If it was good enough for the king, it must be safe for everyone else. The corruption went even deeper. The South Sea Company lent money to MPs and nobles at incredibly favorable terms so they could buy more stock. In some cases, they forgave debts entirely. It was a web of financial entanglement designed to make sure everyone with power had a vested interest in keeping the bubble inflated. This is why the bubble lasted as long as it did. When skeptics raised concerns about the company's actual profitability, they were shouted down by MPs who had been paid off. When critics pointed out that the company's trade with South America was actually quite limited, Having conducted only one actual trading voyage since 1711, they were ignored. The people with power to investigate and regulate were the same people getting rich from the fraud. And the company's directors knew exactly what they were doing. Internal documents later revealed that they understood the stock price was disconnected from reality. They knew the South American trade was minimal. They knew the profits couldn't justify the valuation. But they didn't care. Their goal wasn't to build a profitable company. Their goal was to pump the stock price as high as possible, sell at the top, and get out before it collapsed. The company secretary, Robert Knight, kept detailed records of all the bribes and corrupt dealings in what became known as the Green Book. This ledger showed exactly who got paid off and how much. When the bubble burst and Parliament launched an investigation, Knight fled to Europe with the Green Book. He was never extradited, and the full extent of the corruption was never fully exposed, though everyone knew it went to the very top. By August 1720, the South Sea Company's stock had reached over £1,000 per share. But cracks were starting to appear. Some of the smarter investors were quietly selling. The company's directors themselves were selling secretly while publicly proclaiming confidence. The first sign of trouble came when the company tried to crack down on the copycat bubble companies that had sprung up everywhere. These rival companies were absorbing investment capital that the South Sea Company wanted for itself. So the company lobbied Parliament to pass the Bubble Act in June 1720, making it illegal to create a company without a royal charter. The irony was thick. The South Sea Company, itself essentially a bubble, was trying to pop other bubbles to protect its own. But the Bubble Act had an unintended consequence. When dozens of these copycat companies were suddenly declared illegal and shut down, their investors lost everything. This created the first wave of panic. If these companies were fraudulent bubbles, investors started asking, what about the South Sea Company itself? What was its real value? What were its actual profits from trade? The answer was damning. The South Sea Company had conducted almost no actual trade with South America. The Spanish had granted them limited access to the slave trade, but the volume was minimal. The company's real business was financial engineering and stock manipulation, not commerce. When investors finally started asking these questions, the house of cards began to collapse. In August 1720, the stock price peaked above £1,000 and then started to fall. At first it was gradual, just profit-taking, but by September it was a stampede for the exits. The problem with a bubble is that it only works while it's inflating. Once it starts to deflate, the psychology reverses instantly. People who had bought on credit, paying only 10% or 20% down, suddenly owed money they didn't have. The company started demanding payment. Investors couldn't pay, so they had to sell their shares. This selling pushed the price down further, triggering more margin calls, forcing more selling. It was a death spiral. By late September, the stock had fallen to £400. By October, it was at £200. By December, it was back to £124, almost exactly where it started the year. A full round trip, 12 months of mania wiped out in 12 weeks of panic. The human toll was catastrophic. Thousands of families were ruined. People who had mortgaged their homes to buy stock lost everything. Merchants who had abandoned their businesses to speculate full-time were left with nothing. Aristocratic families that had held wealth for generations were bankrupted. Suicides increased. There were reports of once wealthy men found dead in their homes, unable to face the shame and poverty. Families that had been living in luxury were suddenly destitute. The social fabric of Britain was torn apart. Isaac Newton's losses were particularly symbolic. The man who could calculate the orbit of comets, who had unlocked the mathematical laws of the universe, had been undone by human psychology and greed. He had fallen for the oldest trap in finance, believing that this time was different, that the rules didn't apply, that he could time the market perfectly. Newton's famous quote, "I can calculate the movement of stars, but not the madness of men," became the epitaph for the entire bubble. If the smartest man in the world could be fooled, anyone could. The social rage was immense. The British public demanded accountability. They wanted to know who was responsible. They wanted someone punished. Parliament launched an investigation, but it quickly became clear that Parliament itself was complicit. Over 100 MPs had received bribes or favorable stock deals. They were investigating themselves. In the immediate aftermath of the 1720s crash, Britain was in crisis. The financial system had collapsed. Trust in institutions was shattered. The public demanded justice, and Parliament had no choice but to deliver something that looked like accountability. The parliamentary investigation revealed widespread corruption, though the full extent was never disclosed because too many powerful people were implicated. Chancellor John Aislaby was expelled from Parliament and imprisoned in the Tower of London. He was later released but lived the rest of his life in disgrace. He was one of the few to actually face consequences. James Craggs, the Postmaster General who had taken massive bribes, died suddenly during the investigation. Some historians believe he committed suicide. Charles Stanhope, Secretary of the Treasury, was also expelled from Parliament. But these were middlemen. The real architects of the scheme, the company's directors, largely escaped serious punishment. Robert Knight, the company's secretary who held all the evidence of corruption in his Green Book, fled to Europe. Britain tried to extradite him, but the Austrian Empire, where he had fled, refused. Knight lived comfortably abroad for the rest of his life, his secrets safe. The directors who were caught had their estates confiscated, but they had already moved much of their wealth offshore or into the hands of family members. They lost a lot, but they weren't left destitute like the ordinary investors who had trusted them. King George I's involvement was quietly buried. You don't prosecute the king, even if he was complicit in the fraud. His mistresses kept their gains. The royal family escaped scandal. What about the victims? The thousands of ordinary Britons who lost everything. They got nothing, no bailout, no compensation, no help. The government's response was to confiscate what little remained in the South Sea Company and use it to partially pay back some debts. But most investors recovered only pennies on the pound. This is the pattern we see repeated through history. The insiders who create the bubble get rich and escape consequences. The ordinary people who believe the hype lose everything. The government steps in to protect the system, not the victims. Parliament did pass some reforms. They strengthened regulations on joint stock companies, making it harder to create fraudulent schemes. The Bubble Act, ironically passed by the South Sea Company to protect itself, remained law for over 100 years and restricted the formation of corporations in Britain. But here's the thing about financial bubbles. They keep happening. Humans don't learn. Every generation thinks they've discovered a new paradigm, a new way to get rich quickly without risk. And every generation is wrong. After the South Sea bubble, Britain had the Mississippi bubble in France at almost the same time, with similar results. Then came the railway manias of the 1800s, then the 1920s stock bubble, then the dot-com bubble, then the housing bubble of the 2000s, then crypto. Each one follows the same pattern: new technology or opportunity, rapidly rising prices, mania, insider corruption, crash, devastation. The South Sea bubble taught the world several lessons. First, when everyone is getting rich without producing anything of real value, you're in a bubble. The South Sea Company didn't actually trade much with South America. Their stock went up because people believed it would go up, not because the underlying business was profitable. Sound familiar? Second, when the government and insiders are all pushing the same investment, be suspicious. If MPs are getting rich from it, if the king is invested, if everyone with power says it's safe, that's usually when it's most dangerous, because those people have access to information you don't, and they're going to sell at the top while you're still buying. Third, you cannot time the market perfectly. Even Isaac Newton, arguably the smartest human who ever lived, couldn't get out at the top. He tried to be rational, sold early, then bought back in at the peak and lost everything. If Newton couldn't time it, what chance do you have? Fourth, leverage magnifies everything. The South Sea bubble was inflated by credit. People bought stock with just 10% down, borrowing the rest. When the bubble burst, they didn't just lose their investment, they ended up owing money they didn't have. Leverage turns a bad investment into financial ruin. And finally, the people who cause the crisis rarely pay the price. The South Sea Company's directors knew it was a fraud. They bribed officials, manipulated the stock, and cashed out before the crash. Some faced consequences, but most got away with it. Meanwhile, thousands of ordinary investors were destroyed. Does any of this sound familiar? It should, because we just lived through it again in 2008, and we're probably living through it again right now in some form. The names change, the technology changes, but human nature doesn't. The South Sea Bubble of 1720 was history's first great stock market crash. It bankrupted thousands, including Isaac Newton, the greatest mind of his age. It exposed the toxic combination of financial speculation, government corruption, and mass delusion that would be repeated through history. The lesson wasn't that bubbles can't happen. It's that they will always happen because greed and FOMO are hardwired into human psychology. The lesson wasn't that markets are efficient. It's that they're driven by emotion, not logic. The lesson wasn't that the powerful will protect you. It's that they'll protect themselves and leave you holding the bag. Isaac Newton lost 20,000 pounds, but his warning echoes through the centuries. I can calculate the movement of stars, but not the madness of men. We're still calculating the stars. We're still ignoring the madness. And we're still losing our fortunes in bubbles we swear are different this time. If this opened your eyes to how financial manias work, hit that like button, subscribe for more deep dives into economic history,